Mistake number one, using the wrong reports. So an Amazon seller, for example, most online sellers will have some presence on Amazon is what we found. So if we take Amazon as an example, a lot of sellers are probably used to seeing something like this, the data range summary report, where they basically go into their account once a month and they go into reports, payments, and then the data range summary report, and they download the report for that entire month. And on the left-hand side is all your income, and on the right-hand side is all your expenses. Obviously, this is just a fictitious one, but they would be filled with loads more information below as well. They then think that that is enough. And they basically either pass that to their accountant or their bookkeeper, or maybe they just put those figures into their bookkeeping system themselves. And they just think, right, okay, that's me done for the month. But the problem with this is many problems, but the two main problems are that this report just doesn't contain the level of detail that you need in order to get accurate bookkeeping. And the reasons for that are it doesn't contain where the destination country of those sales has gone to. So if you're selling on Amazon Europe, for example, somewhere in the UK and Europe, and you take that report for your UK marketplace and you download it and you just think, right, okay, all that income is from the UK. You're wrong. That you will have sales that have gone outside the UK. And if you're a UK seller or you're registered for VAT, then you need to be separating those things out, because otherwise you'll treat them all as UK vatable and you'll end up paying 20% on everything. Whereas if you separated out your sales that are going outside the UK, then you would end up paying less tax, less VAT. And it's the same in Australia. So Australia, you've got sales inside Australia, sales outside Australia. And it's the same in the US as well, because some sales will be treated differently for sales tax if you have sales tax permits, depending on where they're going to. So the destination country is a must. The tax that's been applied to each sale, that isn't on there either. And who's responsible for that tax isn't on there either. So again, these are all examples of where the marketplace is collecting the VAT or the tax or the GST. And this happens, like pretty much every seller will be getting some form of this problem if they're using this report. And then the second reason, so that's sort of the first reason. The second reason is that when you're using a monthly report and then Amazon or the other sales channels are paying out once every 2 weeks, once a week, once a day, it's really difficult for you to then line those up to the actual figures that you've put in. And so what we see is that people who've come to us, they will have been doing this previously, where they've taken that data range summary report, they put the income and the expenses into their Xero or QuickBooks account, and then they bring in all of the payments that have come in from Amazon and they put them into a clearing account, and they have like a virtual Amazon bank account where the sales go in and then the payments come in, and then they're always left with this little balance at the end of the month. And sure enough, that should match up to what is in their Amazon account as the reserve balance. But most people don't do that check. And even when they do, they don't really know what they're looking for. And it's really hard to like get the exact balance at the exact endpoint of the month when the payments are coming in sporadically during the month. So what it means is that people are just never really confident on that running balance. And their accountant might ask a question like, oh, that balance that's showing in your clearing account, do you know that? And they're like, oh, yeah, it's just the money that's due from Amazon. So it goes on throughout the whole year. And then at the end of the year, then their accountant has to make some sort of adjustment because that balance was not actually correct. And so you're just asking for trouble basically by doing it this way. And so what all this can result in is inaccurate accounting, which means that you pay too much or too little tax. And they are bad things, because if you pay too much tax, it's money you should have kept. And if you pay too little tax and then the government finds out, then they'll charge you a penalty and they'll charge you the tax that you should have paid. So neither of those are good.